Hello, my name is Rob Newman. I am the tax partner of Carter Collins and Meyer, firm of accountants based in Rochdale, Greater Manchester. Today's video is 13 topical tax tips to save you money in 2021-22, easy for me to say. The tips are nice, vanilla tax planning, which HMRC will not find contentious and which will not get you in any specific trouble with them. Without further ado, I'm going to share my screen so that we can both see the slides. The slides will be put under this presentation on YouTube channel, available for download there. So here we go. 13 topical tax tips. Number one, check your tax code. HMRC only set a code number based on what they are told, essentially by you and your employer. Mistakes happen, so don't just throw your coding notice in the bin once you have got your payroll department to update it. Make sure you actually see that it's correct. I have seen disastrous ones of these go on for ages and ages and ages, particularly with PAYE employees who don't fill in a tax return at the year end and therefore don't have anybody else checking their tax code. I've seen people pay benefits in kind on things that they gave up 10 years previously. One of the worst examples of this, and I know she won't be watching because she never does, is actually my wife, who continues to have benefits in kind in her tax codes that she does nothing about. Tax tip number two, you do not have to earn to obtain tax relief on pension contributions. If you pay £2,880 a year into a pension scheme, HMRC will add a further £720, regardless of your income. This operates well for non-working spouses and is probably the best bit of investment advice that is not regulated I could possibly give you. And yes, I'm not regulated by the FCA for investment advice. If you look at the return on that, 720 on 2,880, it is a fantastic return. If you have cash floating around, please do consider making pension contributions. Tax tip number three, consider salary sacrifice with your employer making further pension contributions instead of taking them as salary. The advantage being the saving in national insurance for both yourself and your employer. If they pay it to you first and then you pay it into the pension scheme as a voluntary contribution, both of you will have suffered national insurance, which can't be offset against anything. Whereas if it's done as a salary sacrifice from gross earnings, you both save. This is particularly relevant if you're an owner-managed business, and something that I certainly put in my 7 top saving tax tips for business owners. Tax tip number 4, you will know that there is a £1,000 allowance for income generated by savings. But did you realize allowances can be as much as £6,000? If your other income does not exceed your personal allowance, the first £5,000 of interest income over your savings allowance is taxed at 0%. In other words, if you are a very low earner who generates income from savings, this is going to apply to you, and is something that you may not know if you don't inform your accountant of it. Tax tip number 5, gift aid payments. Give tax relief at your top rate of tax, but have you considered carryback provisions? Provided the election to carry back is made before the normal filing deadline, the payment can be treated as being made in the previous year if you were a higher rate taxpayer in that previous year. It must, however, be entered on your tax return. You file, not an amendment to the previous year, and please make sure that all gift aid payments made by your spouses are also noted. In other words, if you make gift aid, if you make any contributions to any form of charities, please do let your accountant know. Or if you're not using an accountant, make sure you're filing tax returns and claiming the appropriate relief. Tax tip number 6, if you are not liable for national insurance contributions, you are not liable for national insurance contributions after you reach state pension age. Neither are you liable if you are below the primary earnings threshold of £184 a week. If you still qualify for the state, but you will still qualify for state pension and related benefits if you earn over £120 a week. Remember that if you think you're missing out on anything and you are below pension age, you should look at making voluntary contributions under class 3. This is something that CCM are starting to address with clients, particularly in the last few years, where we have noticed very low salaries have been paid. If you follow our advice in terms of what salaries have been paid, we will have ensured you have stamped every year, but any gaps in your pension history, you may wish to make the voluntary contribution. We are thinking of doing this as an extra service, a pensions audit, for want of a better term, considering what isn't available to you. Tax tip number 7. If you have children under 16 or under 20 in approved educational training, make sure you register for child benefit. However, do be aware that if you earn over £50,000 a year, your child benefit will start to be being clawed back. Something that is definitely worth checking and letting us know that you have claimed if you are working with CCM. We've had a number of inquiries this year of people who didn't tell us about their child benefit charge, but did go over £50,000 of earnings. And remember, it's only one person in the household needs to go over £50,000 of earnings. This is one of the silly things of it. You could both earn £49,000 a year and not suffer the child benefit charge. But if one of you earns 51,000 and the other earns 0, you will suffer this. So again, if it's an owner managed business, do give consideration to how you split earnings between yourselves. Tax tip number 8. Don't forget marriage allowance, which can be transferred between spouses of £1,260 at a rate of 10%. This gives a potential tax saving of up to £252. It can be backdated to any year from 17. Again, something we automatically check at CCM if we are doing your tax return, but if you are not using an accountant, something for you to look out for. Tax tip number 9. Everybody has an annual allowance for capital gains tax of £12,300. Consider transferring shares or unit trust to your spouse or civil partner before they are sold so that their allowances are not wasted. What that means is if husband and wife owns a load of shares, before she sells them, it would be well worth transferring shares with a gain of up to £12,300 to the husband. Husband and wife transfers, civil partnership transfers do not suffer capital gains tax and are carried over at the original base cost of the original acquirer. If you want to use up your annual allowances but keep the shares in the family, you can sell them in the market and your spouse can buy them back immediately, known as bed and spouse, which gets around the previous bed and breakfast rules. Again, something well worth considering if you're sitting on shares, and certainly something that I know one person that we work with certainly does do each year. Tax tip number 10. If, like many, you've been working from home in the pandemic, don't forget that you can claim an additional £6 per week. This is actually an allowance that's always been there, and again, something that CCM always do for their clients. Please make sure your own accountant is doing it, both for the pandemic or elsewhere, but you do actually have to be working at home in order to claim it. Tax tip number 11. Why not get a bit of extra income? If you're prepared to rent out one of your rooms to a lodger in your own home whilst you live there, you can get £7,500 a year of income without paying any income tax on it, or without incurring any eventual capital gains tax. In addition, if you let your home out on Airbnb, the first £1,000 of income from Airbnb should escape through the rental allowances. Downside of both being, of course, you've got to actually rent your home out, something that is not necessarily what you want to do, despite me being a big fan of furnished holiday let. Not going to cover that in this particular thing. Tax tip number 12. Have you ever thought about selling off your surpluses on eBay? I certainly do. I have a number of passions outside of accountancy. Clearly, this is my most interesting thing. Watches has long been a thing for me, together with clothes. A little bit of a clothes horse. I do trade both on eBay. I have never lost more than £30 on a watch ever. In fact, in most cases, I probably make money on them, but I invariably buy more watches with it, and I am selling them only so as to enable me to buy others. Clothes, something similar. Surplus items like this are not caught by income tax unless they were bought initially with the intention of selling them on at a profit. Even then, there is a £1,000 allowance. Do think of this. It's amazing how much you can actually clear out of your own home. I know certainly in the last year, I have shifted in excess of 30 blue IKEA bags full of old clothes that no longer fit my post-pandemic fat body. And finally, tax tip number 13. If you are concerned about inheritance tax, remember that apart from the £3,000 annual allowance and the 7-year potentially exempt lifetime gift rules, you can make payments of any amount free of IHT if they are regular out of surplus income and they do not reduce your standard of living. If you are interested in this, I would suggest dropping me an email at inquiries@uk-ccm.com. That probably sounds a little bit like gobbledygook in the first instance and is something that I can potentially establish with you fairly quickly. Also, on top of the regular gifts out of income, remember there are no limits on the amount you can pay to maintain your children up to the age of 18 or until they cease full-time education or training. And that's it, our 13 quick and dirty topical tax tips. I can be contacted at inquiries@uk-ccm.com if it can be of any further assistance, or if you would like to sign up to our clients only newsletter for viewers of this, I am happy to give away free copies. It comes out monthly. Pay less tax, make more profit. Delivered by email, great resources, get lots of comments about them, some really nice stuff being said on Google and our own website, which can be viewed at uk-ccm.com. Thank you very much for watching. This is Rob Newman, tax partner at CCM.